So what is a covered put? Good morning, options traders. And this is a question that you hear a lot, especially from our new traders. And they'll say, well, I've heard of a covered call. And now with all the recent market volatility, I've been hearing about a covered put. What in the world is it? Well, good question. And it's really just the sister strategy to a covered call. What does that mean? And why would you use it? Well, let's go find out. And as always, before we do, please be sure to click like and subscribe. Goes a long way into promoting the channel and is definitely very much appreciated. So to kick things off, let's start with a recap of the covered call, just as a reference point. Covered call is where you are going to either currently own shares or go out and buy them. Let's say that you buy 100 shares of stock and you pay $100 per share. Next, if you wish to enter a covered call, you might sell the $100 call. Doesn't really matter which strike, and there are definitely different reasons why we would choose different strikes. But for right now, let's just pick the 100 and say that we collect $5 for that. We're going to receive cash from selling that call. Now, when we do this, we have the potential obligation to sell the shares. The person who buys the call has the right to buy the shares. We have to stand by ready, willing, and able to sell these shares if the long call exercises. But then you might think, well, big deal. I own the shares. I've got them to deliver. And that's what makes it covered. See, if you just sold this call by itself, it's what's called a naked call. And that becomes very dangerous because you would still have the obligation to deliver shares for 100. But what if the stock price is 120 or 150 or 200? It does happen. You might have to go out into the open market and pay 200 for the shares and deliver them for 100. And that would be giving you a very big loss. But in this case, it's like you're buying the shares, putting them in inventory and saying, no big deal, I can always deliver the shares because I've already purchased them and I know my purchase price. So that's the covered call. Now in this case, we would have a break even of 95, and that is just the difference in these two cash flows. We spent 100, but we collected $5. Now when we do that, if this is our strategy, this is our risk graph. We get the bend right here at 100. That's our strike. And there's our break even at 95. That's where the blue line crosses zero profit and loss. Maximum gain in this example would be 5. Now here, the entire gain is from the sale of that call. And that's because the stock is worth 100. We have the obligation to sell for 100. Well, there's no gain in that. All of the gain is coming from the sale of that call. Now, if we had sold a higher strike, maybe the 105, we could get some potential capital gains plus the option premium. Those are topics for different videos, and I do have some in here in this forum for those who want to know more about the covered call. But what's the basic idea for selling the call? Well, if we hadn't sold the call, this would be our risk graph. Remember, the shares are currently trading for 100, so that's our current risk. We've talked about that before. It doesn't matter what you paid for the stock. Right now, the shares are worth 100, and from a risk management standpoint, we have to say that's what we are putting at risk. So this would be our risk graph, and notice that by selling the call, we have shifted our break-even point lower. That is the main reason for selling the call. Now, in doing so, we have limited the upside. That's why this blue line flattens out. So if the stock had made a fairly big move, you can see that, yes, at some points, we would have been better off by holding the shares. The black line sits above the blue. But we're willing to sell that off in exchange for reducing this downside and getting some cash up front in the hand. So that's really the basic idea of the covered call. Now, once you understand this, the covered put is exactly the same strategy, just in the opposite direction. This is going to be used for short sellers. So let's say that you short 100 shares of stock, but now you collect $100. Notice when we did the covered call, this was in red. That's because we had to either spend 100 or at least account for the current market value if the stock was trading at 100. Next, you're going to sell a put. Now, I'm just going to use the 100 strike as an example, and let's just assume that you collected 5 again. But it's also in green. We collect 100, we collect 5. Now we've got $105 cash, but by selling this put, we have the obligation to buy the shares. Well, that's not a big deal because as soon as you short shares, you have an obligation to buy them. See, that's not true for a covered call. If you buy shares of stock, you're under no obligation to sell them. But if you sell that call, you now give yourself the potential obligation to sell those shares. But if you short shares of stock, whether you short a put against it or not, you have the obligation to buy those shares back. Now, technically, there's no real time limit on that. That's provided there's no buy-ins and that you could meet any potential maintenance calls. But it's still an obligation to buy those shares back at some point in the future. So again, you're thinking, all right, well, big deal. As soon as I shorted those shares, I was planning to buy them anyway. But by selling this put, I can collect some cash, and that's going to raise my break-even point to 105. See, when you're buying stock, you'd like to reduce your break-even point. A lower cost basis is a better thing. But when you're shorting shares, it's the opposite. You're trying to sell high and buy low. So we collected 100, we collected 5. The break-even is now raised to 105. So if we shorted shares of stock and sold the 100 put, this is our risk graph. There's our bend right there at 100. And if we overlay it, we can see that it's a bearish strategy. We make our maximum gain. Our maximum gain is for all prices below the 100 strike. So in this example is $5. But notice if we had just shorted the shares alone, this would be the risk graph. We would break even at 100. You see how that black line crosses 0 right there at 100? But notice when we short the put, we raise it. So that's a bad thing if you're buying shares. It's a great thing if you're selling shares. And that is the basic motivation for doing a covered put. It makes it a little less risky and still provides for some profits. Now, what if we had sold a different strike, maybe the 95? Well, like always, just with a covered call, it's just a different set of risks and rewards. So we might look like this. Now we get our bend at 95. We do have potentially more profits because now the stock can fall from 100 to 95 before we have the obligation to buy. But in exchange for that benefit, we have to accept a little lower break even. We used to break even up here at 105. Now maybe we break even at, let's say, 103. Not quite as good, but in exchange, we potentially have more profits. So the covered put, just remember, it is a strategy for short sellers, those who are shorting shares of stock, and traders receive cash from the sale of that put, and the cash raises the break-even price of that short. That is the basic idea behind the strategy. We're trying to raise that break-even point. And in exchange for selling that put, you do have the obligation to buy shares, but that's not really a big deal because the moment you shorted those shares, you had the obligation to buy them back at some point anyway. And so that's really the idea behind the covered put. It's really just the sister strategy to the covered call or the covered call in reverse. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.